Rate cuts from the Fed, Asia. I'm sure there's going to be a bunch more all over the place in the coming days and weeks ahead. Is it going to do anything?
No, they are very important to the extent they protect and support the markets. That's the key thing here. It's not that they support any capital spending or anything like that. What is critical is how they support the markets. And to the extent they support the markets and the financial conditions, they prevent or at least they slow down the economic deterioration that goes on. And you saw last December when the market went down, the reaction in retail sales in December and January. This is a very top-heavy economy. It's driven by top 5%. Most of the other people don't have much discretionary spending power. If the market goes down 10, 15%, you will see bad retail sales again, and the recession will be more likely.
So, Alicia, if you had been in a coma and you woke up, say, mid-June, you would pretty much think the economy was about to fall off a cliff and Armageddon was coming. But when you sort of pull back and look at things over the last couple of years, is it as bad as it seems today?
So the U.S. economy is doing well enough, meaning it's in that 2 to 2.5% range, which is actually pretty positive for risk assets. And we know inflation is low, so that's a positive backdrop. I'll say this, the trade war that started a year and a half ago very slowly started to hit the manufacturing sector, while the services sector held up and the consumer sector held up. What you're starting to see here is that it's starting to bounce into the services sector. And it is true that if we get a 10% correction in the equity market, we will see some downturn in retail sales and consumption. But again, it's transitory. It was transitory in December and January, and it can be transitory again. We don't see this as the big downturn. This is taking risk into the market and really trying to digest what the path forward is for growth and for the trade war.
But Srinivas, the bond market's freaking out to a certain extent when we're looking at flat yield curves, flattest in the US since 2007. I could go on with all the superlatives. Right. What is it that the bond market sees, and how long can this unprecedented time continue with all these negative rates?
Negative rates? Well, this is the point. If you look at globally, you have balance sheets, that is whether assets and liabilities that are very huge in relation to the actual economic activity, right? Nominal GDP, and if you scale it to assets, which means by definition, it's the income produced by those assets is low, so yields are low. That's either you have to write down those assets or they have to fall in a big recession, or you have to have negative yields. Those assets are not going to earn their keep. One or the other. That's basically the point.
Alicia, from your perspective, obviously, we look at the moves in fixed income and our jaws drop with some of them. But is there anything special about negative rates, or could we just keep going deeper and deeper and more negative?
So I find negative rates scary in that they're clearly not able to get the real economy going, and you're murdering the banking sector.
Yeah.
And Europe is a great example of that. I actually think that Germany is going to be forced to have a fiscal policy.
Finally.
And to have fiscal stimulus. And actually, if this happens, it could really change the whole risk sentiment of the entire market. You have to get out of this position. I do worry about rates here in the U.S. There's no reason the Fed should be cutting 100 basis points by the end of the year, simply to be following other global central banks. Our economy does not warrant that. And, at some point, the Fed is going to have to confront the market on this, I think, because you cannot go into the next recession with no ammunition.
Right. Well, Sri, this brings up a good point. Why are we so afraid, I just mean sort of the royal eye here, are so afraid of sort of a market cycle ending? This idea that you have to keep this going, market cycle, economic cycle going. There seems to be this fear of just allowing sort of the economic cycle, the market cycle to correct, reset, and then go on to the next great thing. We can't bridge that somehow?
Well, recessions are very painful, and they hurt the poorest people the most, because if you see the expansion, it has taken this long for the bottom 20% to see some real wage gains, right? Mm-hmm. So they really hurt the bottom, the bottom 20, 30, 40% people the most. So they are very painful, and they have long-lasting effects, too.
But we have had recessions that weren't necessarily as painful as...
That was way back then. When there used to be inventory recession, people used to shut down the factory for 6 weeks, and then they would come back quickly. And there were no permanent layoffs back then, So they were very different, the early post-war recessions. This is very, very different from those. Each of the last 3 recessions, we have had extended jobless recoveries, and it's taken a long time for the unemployment rate to come down.
Anisha, you're clearly keeping a keen eye on manufacturing, on services. You've been worrying about the bond market, but You seem optimistic this isn't the end of the road for the equity market. What are you keeping a close eye on in terms of market shows that we've got life in us yet? Is it the stocks? Is it the chips that people keep turning to?
So I think that the heavy trade has been the bond market, right? So all flows have been going into the bond market. And it would not be surprising on a tactical basis to see yields hit the old low from 3 years ago of 135 in the short term. But having said that, you know, the compression on yields on the 10-year is a bit out of control of either the Fed or anything that's happening in the U.S. economy. And it's resulting of the fact that we've got $14.5 trillion of negative yielding debt, and this is the only way to go. I think that ultimately there will be some sort of calming down of the trade rhetoric. And we've already seen China be very clear about where it's setting the exchange rate so as not to deviate too far from the 7 number. And I think that the voices coming out of the administration appear to suggest that there is a path forward. That doesn't mean we need a trade deal to get this going. You just need it not to ratchet up to 25% on the next $325 billion of imports.
Sri, Alicia said something very important. It's like everyone's just waiting for that German fiscal stimulus, but who knows when it's going to come because of politics. Is there anything else out there besides that lever that everyone's been talking about for like
And China
years?
does some massive stimulus.
Could that be the thing
done.
that changes the equation and reflates the global economy? Do they still have the power to do that?
Well, they have the power always to the extent that, you know, they control their domestic money supply and they can do it. And they still have a lot of reserves. They can clamp down on capital flight. You know, they can do a lot of things. I mean, of course, they are closer to the end of the rope than they were like 3 years ago, but certainly they're not at the end of the rope necessarily.